Futures Trading 101 Part 2. So margin. Margin is essentially a good faith deposit. It represents a small percentage of the total dollar value of the contract you have agreed to buy or sell at a future date. There are two main types of margin that you need to understand because it's about having that available margin, that cash in your trading account to be able to cover these margin requirements. So intraday margin is the per contract minimum amount of money required in your account to hold a position during that regular trading hours, and we're going to go through some examples. So also then that initial margin is the per contract minimum amount required in your account to maintain a position overnight. So initial margin is significantly larger than that intraday margin requirement because it is riskier for you to carry that trade over to the next session because there could be a gap and the broker needs to cover that risk. So an intraday margin example. So to trade one contract of crude oil futures, and the symbol is CL, $CL. The intraday margin is put aside from your futures account when you enter the trade is $2,000. Okay, so you need a minimum of $2,000 to trade that one contract of oil during that day. If you close the trade in the same trading session, then it's released by the broker. So remember, we did an example in part 1 where we looked at CL, and every cent that CL price moved, you made $10. Now, this is probably a standard type contract, but you need $2,000 in your account just to be able to trade that one contract of oil. So initial margin example, so if you want to carry that one contract of oil, CL, over to the next session, the broker will need another $8,250 to be put aside from your account balance to carry the risk of keeping the trade overnight. So imagine that you are in a really great trade and you want to carry it overnight. Unless you've got over $10,000 in your account, you are not going to be able to do that. And this is that no fluff side of futures trading. But there is light at the end of the tunnel, and we'll come on to that. But to trade one contract of oil, to carry it out overnight, another $8,250. That's that initial margin. So to avoid accidentally carrying a position past the close, you need to be aware of futures contracts trading hours. It's imperative for day traders. So for the majority of brokerage clients, intraday positions must be closed 15 minutes prior to the session close. So that's 3:45 p.m. Central Time for the majority of the popular CME futures contracts, which is 15 minutes before the official session close at 4 p.m. CT. So it's about having that daily routine. If you don't have the margin to carry over that particular trade, you need to be aware, you need to be in front of your computer ready to close that position before 3:45 p.m. Central Time. So another type of margin, exchange margins or maintenance margins, they're set up, they're a minimum margin per outstanding futures contract that a trader must maintain on positions carried longer than one day. So if you've carried it over one day and then you want to carry it over again, so you're almost swing trading this futures contract, it's slightly less, but you need to have that margin available. So with that same contract of oil, remember we needed that initial margin $8,250 on day 1. If you carry it over another day, you will only need $7,500. So the broker will put aside $7,500 when that's carried over, rather than $8,250 for each day that goes forward, as long as the trader doesn't trade. So an account that adds to a position, so long 1 to long 2 contracts, would have to meet initial margin for both contracts the day contract 2 is added. So that's $1,700. Sorry, $17,000. So again, essentially, that's resetting that margin. So some examples. This is taken from NinjaTrader for the margins. So we can see here On E-mini S&P 500 futures, the intraday margin is $500. So to get in one contract of ES during the day is $500. And if you close it out for the end of the day, that's all you have. However, if you want to carry that over, that initial margin is $11,000. And that maintenance margin going forward days and days and days is $10,000. Okay. Now this is where micro futures come in, because to trade one contract of MES, the intraday margin is $50. But obviously that's a tenth of that 500. So you only to trade ES every time that moves 1 point, you get $12.50. So divide that by 10 is $1.25. So there's less profit to be made on micros, but it's more affordable for traders with less capital to put against for margin. Again, if you want to carry that one contract of the micro MES over, it's $1,100, and then the maintenance margin would be $1,000. So there is light at the end of the tunnel for those traders that don't have big $50,000, $100,000 accounts. So CL, for example, we just talked about that in an example there. $2,000 is the intraday margin. 8,250 is the initial margin. And then when you compare that to the micro oil futures is actually only $100 for that intraday margin, and then $825 to carry that over. So that initial margin, $750 for the maintenance. So that's actually cheaper than the micro ES. Yes, you're only getting on the micro oil $1 per point moved compared to $1.25, but it is a cheaper futures contract to trade. So there are ways to do that, and again, there's a lot more learning to do, and this is just a very brief. There's only 3 parts to this, to these sessions, and it's just to get those basics so you can understand. No fluff. Be realistic. You need this amount of money to trade this type of contract, and these are what all the main statements and all of the different terms, and this is what we're covering in these sessions. So expiration delivery. So it's an important aspect of trading futures is understanding that the futures contracts ultimately expire and cease to exist. So on the expiration date, in theory, futures contracts may call for a physical delivery of the commodity. So if you bought oil futures, in theory, you would be expecting to receive that oil, while those are settled in cash. But don't worry, when you make a futures trade, you don't need to make or take delivery of the commodity. In fact, if you're like the vast majority of futures traders, you'll be offset your position long before ever being faced with a delivery process, because you're in and out really, really quickly. So those expiration dates are very important, and they're the way that these contracts are put onto a chart so you can see them. It consists of a few things. So the type of commodity, whether it's oil, for example, or the asset being traded, the month the contract is for, so that's the month that it expires, and then the year in which the contract is for. So these are the standard lettering for January through to December. An example on the right here, we have CLZ22. So this is a crude oil futures December 2022 contract. That's when it runs out, in December 2022. NinjaTrader does it slightly different to make it a little bit easier. They would have this simplified with CL for oil, 12 for the month, December, and then the year 2022. So those are the contracts, and those are rolled over with your brokerage. Some is automatic, for example. Others, you will get a notification like on NinjaTrader that the contract has expired and you need to roll over to the new contract. You select OK, and it rolls it over to the next contract on your chart, so you're up to date with the current contract data. So trading symbols. In futures trading, each commodity has its own symbol. So for example, CL, we've used this in these examples here for crude oil, or ES for the E-mini S&P 500. So then with that introduction of micro futures, the exchanges have provided cheaper futures contracts for those traders struggling to meet those margin requirements for the regular E-mini futures. So instead, we have the MCL, which are micro crude oil futures, for example, or MES for the micro S&P 500 futures. So this introduction of these micro futures allows more access to traders that don't have massive amount of money, that have $10,000 and are able to trade a few of those micro contracts, get into the futures markets. So a couple of other things, volume and open interest. So volume really tells you how many contracts traded hands in a particular contract or market. So total volume equals the contracts traded. So the purchase and sale of a single contract counts as one, not two. So in and out is one. Volume helps measure the strength of price movements, and one of the things in our apprenticeship scheme is we talk a lot about volume and how to help understand the behavior of the markets, because it really helps measure the strength of the price movements and how much, I call it juice, how much juice it's got going up or how much juice it's got going down, and then you can see that juice running out as that volume starts to run out. Open interest tells you how many contracts exist, so that are live or active in the market at any given point in time. This is similar to the number of shares outstanding for a stock, for example. So the larger the open interest, the greater the liquidity. So ease in which you can enter or exit the market. If the open interest is quite low, then there's not a great deal of liquidity, and what we talked about in part one, the spread would be a lot higher. Okay, so the last part, Futures Trading 101 Part 3, we're going to go through some simple futures trading strategies. So this is not an educational program, it's purely just to give you some basic terms, what futures trading is, some of the things that are very, very important to understand about risk, about how much money you need to trade those futures contracts, and then this final part will be just some simple futures trading strategies to help you along your way.